In this video, I'm going to be discussing my dividend growth portfolio, taking a look at some of my winners and losers and why they moved in the direction that they did. I'll also touch on the elephant in the room, which is this ugly looking graph right here, and talking about the stocks that I sold and the ones that I bought. I don't really have any topic of discussion to talk about today because I kind of messed up my plans, but it's whatever. But first, let's move over to my pies. Oh yeah, I'm back on my phone, aren't I? I thought I'd just switch it up a bit because the desktop was kind of getting stale for me, but I'll probably be back on there next week, we never know. And if you want to find out what I have in my pies, links to that are in the description. So yeah, my dividends are slacking in comparison to my other dedicated pies, and if we actually go into it, we can see that it's mainly being held back by AT&T, which is currently down about 10% for me. I believe that they have their earnings this week. I want to say Thursday, but I'm not 100% sure. So we could see some drastic movements depending on how well or how bad it is. But yeah, apart from that, all my other pies have been performing pretty decently. Cool, so yeah, let's start off with my winners this week. And actually for that, we have to go over to my investment account because I have some stocks over there that are not eligible to be held in an ISA. Yeah, so this account is performing rather well in comparison, but I guess that's what you can expect when you're only invested in 3 stocks. That Under Armour stock was from a referral. I don't actually put money into that. It's always the stocks that you don't put much money into that go up the most, isn't it? Goodness sake. Right, so in second place we have I've never understood how you pronounce the name of this company. I've been saying NIU, I've been saying NIU, I think I'll just call it NIU Technologies. So yeah, in second place we have NIU Technologies, meaning that NEO is obviously first. But let's start off by talking about NIU. So on the 9th of October last week, they had their earnings for the third quarter, which were evidently strong. Its total deliveries in the first 3 quarters of 2020 surged 43.2% to around 450,000 units on a year-over-year basis. They mentioned that they had sold 250,000 scooters in the third quarter, which is up 67.9% from a year ago, which is kind of strange when you hear that because you automatically think, wait, how did that happen when loads of people are in lockdown? And the reason being is because the sales in China is where nearly all the business came from, which kind of makes sense because they've handled the pandemic better than most countries. I know they have plans to expand into Europe, so hopefully in the near future we begin to see a more diverse spread of geographical profits and revenues as such, so that the company doesn't suffer from a highly concentrated area of business. But following the company's third quarter sales data release, Needham analyst Brad Erickson raised the stock's price target to $30, which equates to a roughly 11% upside potential from $23, and reiterated a buy rating, saying that numbers exceeded his expectations. At the moment, firms are pretty bullish on NIU with a strong buy rating, and I'm actually quite tempted to make a video discussing or analyzing NIU, so I might do it, we'll see. Coming on to NEO now, and I don't think there's anyone who hasn't seen NEO's performance this week, which was brought about due to an issued upbeat commentary by JP Morgan on the overall Chinese new energy vehicle market really. So NEO's analyst from JP Morgan, Nick, upgraded NEO from a neutral to overweight and increased the price target from $14 to $40, and basically had some nice words to say about how well NEO will perform in the market. With their earnings set to be announced mid-November, which I think many people are expecting them to provide good results in, we could even be in store for even more upside from here. So NEO is definitely a stock that I'll have my eye on, and if there's a nice drop between now and their earnings, I'll definitely pick up some more stocks there. Moving on to my top losers, starting off with the worst performer, we have Uber. Now Uber is interesting for me. I'm certainly having another look at it again, thinking about if I should sell what I have and look for better opportunities to invest my money. Given that the effects of COVID look like they'll remain around for a little longer, it might be wise to take my investments out of Uber and place them elsewhere. Maybe I could buff up my positions in NIU or even NEO. In regard to why it's fallen this week, business wise I don't think there's a lot of bad news, but technically there was a bearish pattern that had formed, so I'm just going to blame it on that basically. But in other quote-unquote good news from Uber, they have launched a medicine delivery service in South Africa as it looks to gain more share in the market within the fast-growing online shopping sector in Africa's most industrialized economy. They've also invested $150 million in a ride-hailing deal with SK Telecom to kind of break into the South Korean market and cast off regulatory pressures. This is coming after a failed attempt to build their Uber Eats business over there due to competition. And that's kind of the thing for me. I know Uber wants to expand, but due to red tape and attempting to overcome the big companies that already exist, they don't seem to do well. It's like whatever plan they have just fails. So maybe they just need to re-strategize and, I don't know, maybe look at what they're doing wrong and come back with a better plan. So yeah, Uber is currently under the spotlight for me. And now we have Boohoo, boohoo.com. Why do they keep on coming up? I'm actually quite tired of talking about them, but here we go anyway. So I found an article that linked Boohoo and another company called Select to money laundering, and I don't know the validity of it because I've only seen 3 or 4 articles about it. But yeah, Boohoo and Select have been linked to a group of companies based in Leicester's garment manufacturing district that are involved with money laundering and VAT fraud, according to an investigation by BBC Radio 4. Boohoo said they wouldn't knowingly involve themselves with something like this, so there isn't really much else to say about that. These are obviously difficult times for Boohoo in terms of ethical practices that they have been accused of, but in terms of their business, not a lot has changed fundamentally, which is why I'm still pretty comfortable being a long-term investor. So yeah, those were my top movers in my portfolio this week, and now I'm just going to cover the stocks I've sold completely and the small additions I've made. My portfolio is kind of big, right? I have 44 investments in total. I've been trying to minimize the number of holdings I have so that I'm not over diversified, and so I got rid of some of my dividend and some of my growth stocks. And it's not because they are bad in any shape or form, but I feel like the ones that I've kept better match my criteria. So let's talk about them. I sold Pfizer, AbbVie, City of London Investment Group, UPS, Innovative Industrial Properties, JP Morgan Chase as my dividend stocks. If 10 years down the line any of these companies continue their streak of dividends, then I might just invest in them. But for now, I was too over diversified, and so I wasn't really benefiting from investing as much as I could have. In terms of my growth stocks, I got rid of Visa because I just preferred investing in MasterCard, Take-Two because I would rather invest in the ESPO ETF, which is a gaming ETF if you weren't aware. I got rid of Qualcomm because I was already invested in other chip companies, namely AMD and Nvidia. I also got rid of Netflix because I feel like Roku had better growth potential at the moment. And last but not least, I got rid of Carnival Cruise Lines because I don't want to wait for it to recover. I feel like I can make my money work better by investing what I had in Carnival somewhere else. And the same kind of goes for Southwest Airlines, right? But they seem to be performing better than Carnival Cruise Lines at the moment, so I'll keep them in my risky portfolio for the time being. But if I'm going to have to wait ages and ages for that sector of the market to recover, then I might just sell that stock as well and reinvest that money into something that won't take as long to recover, because I feel like that way I'm benefiting from higher growth potential. From the ETF standpoint, I got rid of my Vanguard High Yield Dividend ETF for reasons I mentioned in my last video, and I also switched up my iShares S&P 500 Healthcare Sector ETF for a Healthcare Innovation ETF, simply again just to benefit from better growth. And yeah, that's where I'm at now. Alright, that's it. That's my portfolio update for this week. Hopefully I can come back to this video later down the line and be glad at the rearrangements I've made. And once again, I don't have any meaningful topic of discussion this week because I kind of messed up what I was planning to do, but hopefully in my next video I will have something more meaningful to end the video with. But I'm going to end it there, and I'll catch you in the next episode.